Okay, so welcome back to the office. We're going to move on now from basic computational methods to more advanced computational methods. And as outlined in the previous video, things can get a little bit complicated here, but try to stick with it and go through all the steps and processes necessary to learn how to do this properly, because we're going to be using this statistical method to calculate volatility throughout the video series, because we actually use this method to learn a lot more than just about volatility. We learn to use it to interpret and get historical perspective from the data. Now, I've got with me Christopher Quill, who's the Institute's statistics analyst, and Chris is now going to take you through the whole process. And as I said, again, please just practice this because it becomes very, very important throughout the video series to make sure you've got this process absolutely nailed. So take it away, Chris.
In this Excel example, we're going to assess the daily volatility of two currency pairs, the Aussie dollar US dollar and the Euro US dollar. We're going to analyze what's called a distribution of returns, and the outcome will be that we're able to get a really good understanding of how these assets behave and the opportunities and risks associated with trading them. So what you'll need to do is have a new Excel sheet open like I have here and save it as something sensible like FX returns distributions, and remember to keep saving as you go along to prevent any loss of work. So the first stage in the process is to actually obtain the data. So we're going to look at the Aussie dollar US dollar first, and a website that you can actually obtain daily historical prices from is investing.com/currencies. And then this has basically historical data on almost any currency pair you want. But we're going to look at the Aussie dollar US dollar, which is here. So if you click on that, it takes you to a summary page for that asset. We're going to go to historical data, and we want to look at daily periods, as I discussed earlier. And with the time horizon we're going to look at is from 2008, so 1st of October 2008, until March 2015. So the 1st of March 2015. So you select those two dates there and click apply. And then that gives you all the daily price data within that time horizon that we selected throughout the page. Now there's no quick and easy way to extract this data into Excel, or not in terms of downloading it straight to Excel. So we have to use a rather crude method, and that is just scrolling to the bottom of the web page, so where the data sort of begins from 2008, and manually kind of clicking and dragging over it to select it, and then select all the data up until the top, and including the column titles. So the quick way to do that is, as I've done there, select a few at the bottom and then scroll to the top of the web page and then hold shift and left click before date, and that will select everything up until then. Then what you need to do is copy that data, so press Ctrl C, copy that data and paste it into Excel with Ctrl V into cell A1, and you'll see that all the prices are imported as they were with separate columns on the web page. The next thing we can do just to tidy up a bit is just change the column width so that we could see the date properly and the percentage change. So to do that, all you do in Excel is go to the intervals between the column sort of headings and click and drag the column width. To understand volatility in asset prices, we need to analyze their returns. So the next step is actually to calculate some daily returns using the data that we've got. So we're going to calculate daily returns in two ways. One is the open to open percentage. So in column G, I'm going to head that open to open percent and adjust the column width appropriately. And then in column H, we're going to look at high to low returns as well. High to low percentage returns. So what we're going to do here is essentially just calculate the return from one day to the next using the opening prices, and high to low calculate the returns of sort of investing at the low and closing at the high of each day. So to do that, for the open to open returns in cell G2, we do our first returns calculation, and we say equals to open brackets open of today minus the open of yesterday divided by the open of yesterday, and that will give us a percentage return there. So you can see in Excel that it uses cell references, so that would be today, or the first day that you're looking at, C2 minus C3, which is the day before, divided by C3, which is the day before, which gives you a percentage return from February the 27th in this case to March the 1st. And to quickly and easily sort of copy that down for all the cells in the column, we just double click this sort of black box once it's highlighted in this cell. Double click this black box in the bottom right, and that will copy it down as far as the rest of the data goes. And if we scroll down to the bottom of the sheet, you can see it goes to the end of the data. The only error that we have here is in the final cell, which is a div0 error. And the reason why there's an error there is because it's trying to reference data from the day before that we don't actually have. So it's trying to go before October 1st, and we don't have data for that. So we can just select that cell and press delete to get rid of that. Next, we move on to high to low returns, calculated in a very similar way. This time we use the high and the low of the same day. So we're taking the high minus the low as a percentage of the low, so divided by the low, and that gives us a percentage return if we were to invest at the low and close at the high each day. And the open is investing at the previous open, closing at sort of the current open, and looking at that historically. So now we've got our returns for high to low and open to open, so two sets of daily returns. If we select those two columns, so click and drag over G and H to select them both, and then right click within the selection and go to format cells, we can format them as a percentage to 2 decimal places, or we use 3 decimal places there, and that just makes the returns values a bit easier to understand and a bit tidier as well. With each set of returns data, we're going to create a frequency table and a histogram plot. So these are essentially going to show us the frequency of returns landing in different ranges. For example, the number of open to open daily returns that land between -1% and 0% in the data set that we're analyzing. So first of all, we're going to define some ranges using intervals. And obviously different assets have different volatilities, and so the ranges created do require some discretion. However, a good place to start is looking at returns in roughly 20 ranges between, say, -3% and +3%. To define those ranges, the intervals that we start at are at -3%, and we increase incrementally by 0.3% up to +3%. So we're going to do that now in column J. So I'm going to head the column intervals, and then underneath that start at -0.03, which is -3%, and then in the next cell down will be -0.27 for -2.7%, and then if we click and drag over those two cells that we've just entered there, and then drag the black box down, so copy this down, we can copy this down however many cells it requires to go up to 0.03 there, so that's +3%, and it's going to use the same interval as was used in the first two that we dragged down, so that's 0.3% for each one. So those are our intervals that are going to define the ranges that we analyze our data with. So now we can create a frequency table to show the number of returns that lie within these ranges. The easiest way to do this is using the data analysis tool within the data tab. So if we click on the data tab up here, and then go to data analysis here, we'll be able to move on to the next stage and create this frequency table. However, some of you may not have data analysis already installed as an add-in within Excel. So what you'd need to do is go to File and then Options, Add-ins, and then press Go, and you'll need to make sure that the Analysis Toolpack add-ins are checked, and then press OK, and you should see this data analysis function here just pop up. So let's continue by using that. So if we click on data analysis, we're going to select the histogram analysis tool, click OK. So the input range for our histogram is going to be the actual data that we're analyzing. We're going to analyze all the open to open returns first before we move on to high to low. So we need to select the input range, which is all the open to open returns in our data set. So that's from cell G2 down to the end of the sheet. So the quick way to go to the end of the sheet from here, after you've selected G2, is holding Control Shift and then pressing the down arrow on the keyboard, and that will automatically select all the cells down to the point where there's a gap. So that's down to 1996 there. So then if we scroll back up to the top of the spreadsheet, we can put in our bin range. Our bin range is just the intervals that are going to be used to sort of define the ranges. So we've created that here, that's why we did that. So if we just select from J2 to J22 there, and then we want to select the output range for our frequency table. You need to be a bit careful here, because once you click output range, select output range as the option, it will automatically kind of move the cursor back to the input range for some reason. You need to make sure you click back within the output range box and then select cell K1, so we put it next to our intervals here. And then we just click OK. And that gives us our frequency table data. So you'll see that the bin values are the same as the intervals. So that's why we define them there. And they're going to sort of define our ranges, and we'll go on to naming those properly in a few moments. And then we've also got a frequency count next to all of these intervals. So what this actually means is it's telling us, this frequency table is telling us the number of data points or returns that lie within the ranges that the intervals have defined. So for example, if we look at the first one, we can say that there's 10 days when the returns are less than -3%, so minus 0.03 in the interval range here. When analyzing, our open to open data. So how it sort of works is the first number here is actually the number that's less than the first interval. The next number is between the first two intervals. So there's 8 occurrences, daily returns, open to open returns between -3% and -2.7%, and so on. That goes all the way up until you get to greater than 3% when there's 12 occurrences. So from here, what we can do is plot a histogram from this frequency table, and that's essentially just a column chart. So if we select from cell K2 down to L23, so this range here, so the intervals and the frequency, and then go to Insert, Column Chart, and just choose the first one there. This gives us a histogram or column chart of all our data. So before we go any further and I talk about this, I just want to tidy this up a little bit. So we don't need this series 1 label here, so if you click on that and press delete, that will get rid of that. What we'll also do is give the chart a title. So if you go to Chart Tools, with the chart selected, go to Chart Tools, Layout, then Chart Title above Chart. We can put in a title here by selecting that chart title there, and we're going to name it Open to Open Returns. And then we'll have we'll label the y-axis and the x-axis. So to do that, you go to Axis Titles, we'll label the vertical axis, so the y-axis, rotated title, and this is just going to be frequency, and then the x-axis, so the horizontal axis below, we'll do range or returns range. We'll do returns ranges. So that sort of explains the data a bit more that we've got there. And I think actually before we go on to any more, we'll kind of tidy this up a bit further, because at the moment it's not very clear as to what our ranges actually are, because we're just using intervals at the moment. So what we want to do is put in, so name in column M, we'll put text labels. So that's going to be text labels for to identify the ranges, and we'll change this x-axis here from looking at the sort of interval numbers to actual text, proper text labels for the ranges. So what we can do here is first of all select all the cells that are going to become text labels for our ranges. So that's M2 to M23, and then right click within that selection, format these cells as text and press OK. And then we can start just going ahead and manually labeling these ranges. So the first one will be less than -3%, and 10 occurrences happen there. And then as we continue, the next range would be -3% to -2.7%, and then -2.7% to -2.4%, -2.4% to -2.1%, and so on. We just keep going through the whole frequency table like that. So next -2.1% to -1.8%. And you'll notice at this stage probably as well that as we go through naming these ranges, more and more occurrences are happening as we sort of tend towards 0, or the mean of the data we're looking at, and we'll get onto that a lot more later. It's a little bit of a tedious process this, but it's necessary just to make things clear on the histogram so we know exactly what we're looking at. You might be wondering at this stage why we have so many intervals. Well, the reason is so that the chart, the histogram, is easier to interpret. So we actually get an idea of smaller ranges, what the occurrences that happen in smaller ranges. Obviously, this task would be easier with less intervals, but we're more concerned with how we interpret the data at this stage. So almost done here. So the final range that we look at here is more than 3%, so greater than 3%. And that's all our text labels done for our ranges that we're looking at. So let's just adjust the column width there so it looks a bit neater, and the purpose of that was to put it into the graph. So if you right click on the graph and then go to select data, then we edit the horizontal axis labels, click on edit there. At the moment it's looking at the bin range, so that's just the intervals. So we're just going to move that across to M. So we want to look at, we click in that range there and go from M2, and change the other K to M as well, M23. That will select all the text labels that we've just created there. And now our histogram is a bit easier to kind of visually interpret. So now we can see, the distribution there between different ranges of returns. So basically what we've got here is a distribution of returns that we're analyzing across different ranges, as we've discussed. And you can see that much more of the data generally lies near the middle of the chart than in the tails, again, as you might expect. And this sort of rough shape here is a typical example of what statisticians call a normal distribution. A normal distribution is a bell-shaped frequency curve like we have here, and is one of the most common occurring probability distributions that can be seen in many different areas of life. A typical example often used is actually human height. So you'd have here human height instead of frequency here, as we've got, and then human height instead of percentage returns, and we'd split them into ranges as well, and you sort of get a perfect kind of bell-shaped normal distribution from that. So a perfect normal distribution is actually kind of symmetrical around the mean, and it has defined frequency percentages in different portions of the distribution, which we'll come on to a bit later, and we'll also look at how our distribution here is a little bit different from the perfect normal distribution. Before we move on to any of that, I'm going to show you how you can quickly obtain some summary statistics for the open-to-open dataset that we're looking at. So I'm just going to move this histogram to the side for a moment, and we're going to use the data analysis tool again. So if we go to data on the ribbon and then click on data analysis, what we can do is go to an analysis tool called descriptive statistics there, click on that and then click OK. And the input range that we're going to use is the open to open daily returns again, because we're still analyzing those daily returns as opposed to high to low. And the input range is going to be similar for the histogram data, or similar to the histogram data. So that's going to be from cell G2 to G1996. Then you scroll to the top of the spreadsheet again, and we want to set the output range to this time Q1. Again, be careful to reselect the output range since it sort of automatically puts you back in input range. And then just check the box that says summary statistics, and then that will give us, when we press OK, a bunch of summary statistics for our open to open data set. And before we kind of look through that in any detail, let's just change some of these to percentages so that we can look at them a bit more closely. So mean, standard error, so mean down to sample variance, if you select all of those and format those as percentages to let's say 3 decimal places, and then we'll do the range maximum and minimum also as percentages to 3 decimal places, and kurtosis, skew and sum just as numbers to 2 decimal places. Okay, so let's go through and look at what these statistics actually mean, interpret them a bit more closely. So the mean is the average open to open daily return for the Aussie dollar, US dollar over the period that we've analysed. The median here is the middle number of the data set when we arrange it in numerical order. So if we have a set of numbers that is 1, 2, 3, 4, 5, the median is 3 because it's the middle number when it's listed in numerical order. The standard deviation is a measure of dispersion or volatility in the data. So this is a key statistic that we'll consider in terms of opportunity and risk when trading an asset. Kurtosis, that's basically a measure of how peaked the data is around the mean. so in the middle of the data set, and how large the tails are, so the extremities as well, when you compare it to a normal, a perfect normal distribution. So any number greater than 0 in Excel for the kurtosis value basically means that the data set you're looking at is peakier and has fatter tails. What that means is if it's got higher peaks, so more frequent occurrences by the mean, and also more in the extremities, obviously it has to sacrifice some data in the sort of middle sections, or the left and right middle sections of the distribution. So there's less occurrences sort of around here and here to a normal distribution, but more in the middle and at the ends to make up for it. So the skew next. So a negative skew basically means that the negative tails or extremities are larger than the positive ones, and vice versa. The range is simply the difference between the highest daily return in the data to the lowest. The minimum is the lowest daily return, and the maximum is the highest daily return. The sum is a bit irrelevant. That's just the sum of all the open to open returns in our data set. It doesn't equate to the return that you would get if you held the position the whole time. Just make sure you're aware of that. And the count is the number of periods analyzed in our data set. So in this case, 1,995 days. So let's return now to our frequency table, where we can sort of translate our frequency counts into probabilities. So in column N, I'm going to head it probabilities, and column O, cumulative probabilities. Adjust those column widths appropriately, and then all we're going to do is basically in the probabilities column calculate the frequency within that range as a percentage of the total count, the total frequency in the entire data set. So this formula would just be, so cell L2 10 divided by cell R15, which is the total count. Now what we want to do is be able to quickly calculate this for the whole column. So in order to do that, if we fix the reference to the total count, but not the sort of frequency count for each range, when we copy it down, the reference here doesn't move for the total count, but these do. So we'll get percentages for all of them quite quickly. Now, in order to fix the reference, you can press F4 while sort of with the cursor in the R15 bit of the equation, the formula, and that adds a $sign before the R and before the 15, and that basically means it fixes the column R and the row 15, so that cell. And then we press enter and copy down, and that's a really quick and easy way to sort of calculate all those probabilities. If we right click within that selection and change it to format cells, change to percentages to 2 decimal places, then we can sort of more easily interpret that. And then cumulative probabilities, we're just going to work out the cumulative probability from sort of -3% upwards. So the first range is less than -3%, and it's obviously going to be 0.5% as we have there. So I just put this cumulative probability equal to this probability here. The next one will be the sum of these two, so the sum of the first two ranges, so less than -3% and also -3 to -2.7%. So again, a good way to arrange this formula so we can copy the rest down, copy it down in the rest of the cells, is just do this current probability for the range in that row plus the previous cumulative probability. By doing that, you can then copy down, and what you do is you end up with a cumulative probability assessment, which obviously ends up in analyzing 100% of the data. So why have we sort of looked at the probabilities here? It makes it a lot easier to kind of interpret what we're doing, to actually come up with some valuable information rather than just looking at frequency numbers where it doesn't really mean anything unless you know the total count. and I suppose you can get an idea of what they're like compared to each other, but probabilities is something that everyone understands. It makes it easier to kind of analyze. So what you can sort of start saying to yourself by having these probability columns is, for example, quite simply in the probabilities column, you could say between minus 0.6% and minus 0.9%, 6.3% of occurrences land within that range. So you could say, based on historical data, there's a 6.32% chance of this asset on a daily basis using open-to-open returns landing between minus 6% and minus 9%. Minus 0.6% and minus 0.9%. As for the cumulative probabilities, what you could do is, for example, if you're interested in how often the asset loses more than, say, minus 1.5%, you could just take the cumulative number for less than minus 0.5%, which would be here. This is 3.81% of the times this asset loses 1.5% or more. Equally, how much does it ever gain more than roughly a percent? Well, you just do, it's roughly 95% of the times it doesn't gain a percent, so that means 5% of the time you might get more than a percent day trading this Aussie dollar versus US dollar from the open to the open. Now we're going to do a bit more in-depth analysis of our data, and we're going to find out information such as the average positive and average negative returns, and the number of days the asset, so the Aussie dollar, US dollar, is up or down. And to do that, we're going to need to clear some space to work with at the top of the spreadsheet. So I want to create about 10 blank rows at the top. So to do that, I'm going to select from row 1 to 10 on the left-hand side here. Click and drag to select all of that, and then right click within the selection and press insert, and then you'll see that you've got 10 new rows there inserted, and all our previous data has moved down. So what we're essentially going to do here is continue dealing with our open to open returns data, daily data, and like I said before, we're going to work out information such as the average positive and average negative returns, things like that. And what we're going to do is create a formula that is like an average formula that's variable dependent on how we filter our raw data here. So before we move on to that, I just want to show you how we actually filter stuff here. So this raw data here is now from cell A11 across to column H and all the way down. And what you want to do to add a filter to this data is just click any one of the column titles, and then within the ribbon at the top, make sure data is selected and go to filter. Just select that and it will give you some drop down arrows and all the column titles, and when you click on one of those, there'll be various options to sort or filter the data. And like I said, we're going to be using the open to open data still. So one of the things that we're going to be doing is filtering for positive open to open data. So in that scenario, we go to number filters, greater than, and then in this box here put is greater than 0. And that will then filter all of our open to open daily returns for only positive values. And what you may have noticed is that some of the data that we calculated previously, our frequency table, our descriptive statistics, and our graph or chart, has sort of been squeezed together a bit there, and it looks a bit strange. So the reason why it's done that is because we've added this filter here, and we filtered out all the negative or flat rows in our data set. So don't worry, all you do when you clear the filter here, click on the drop down arrow and then select clear filter from open to open, it restores all the rows, and you'll see that you've still got all the data that we worked with previously. So just to make sure there's some clarity here when we continue working out some new statistics, I'm just going to put in another open to open heading here. So from cell I1 to I4, I've selected all those cells. I'm going to go to Home tab on the ribbon and then select merge and center, wrap text, and then the sort of center text alignment there. And then within this cell, which is now a sort of much larger merge cell, type open to open data, just so we continue knowing what we're working with. Now, as I said, what I'm going to do is sort of calculate an average, use an average formula that changes dependent on our filtered data. And we're going to do the same for a count as well. So the number of occurrences that are positive or negative in our data set. So to do that, in cell J1, let's start with the averages. So we'll have average returns and adjust the column width appropriately. And within that, we're going to calculate the average return based on the raw data here, whether it's filtered or not. So the formula for that is equals subtotal, open brackets 1 for the average, that's the function number for average, comma, and then reference all our data. So that's now from cell G12 down to the bottom. So remember, the quick way to get down to the bottom of that data set is Control Shift and down, the down arrow key. And then close the brackets, press enter, and you'll see that we've got an average returns figure there. If I just format that cell to show itself as a percentage 3 decimal places, you'll see that that's exactly the same as our average value, our mean value in our descriptor statistics, which we calculated earlier, which is as you'd expect, because at the moment all our raw data here is unfiltered. Now when we filter it, this cell will change, and the descriptor statistics here, they'll stay the same because they're calculated, they're sort of hard coded in from all the raw data that we analysed before. So bearing that in mind, let's now name another couple of cells. We want to calculate the average positive return. So shorthand, I'm going to use avposret, and the same here for negative returns. And then in N1 and N2 next to those cells, we're going to actually put in the calculations. So let's proceed by filtering the open to open data, going to number filters greater than 0, so we only have positive data in the open to open column. You'll see that there again, we've only got positive open to open data. You'll also note that our average returns formula has now spat out 0.576%, and that is our average positive return. And what we can do is, if we select that cell K1 and then press Ctrl C, copy it in some way, and then we can paste it into N1 for average positive return. So we right click within that cell, and then we want to paste it as a value, as values, which is this clipboard sign here with the 1, 2, 3 on it. And that means that that's basically now hard coded into that cell, and it won't be variable dependent on how we use the filter. So next we're going to change the filter for negative returns. So we go to less than this time, 0. And the same way we copy that cell into N1, N2 this time for average negative returns as values. And that's our average negative return value. So if I just select those two and format them as a percentage again to 2 decimal places. There's 2 things to note quickly here before we move on. One is that they're both very close in absolute terms, and what I mean by that is that their magnitude either side of 0, both positive and negative, is very similar, and so they're fairly symmetrical, which makes a lot of sense because our histogram, if we unfilter our data again here so we can see the histogram better, is pretty symmetrical. So we would expect the average positive and average negative returns to be roughly equal either side of 0. And the other thing to note is that they're both very small return values, only 0.5% in a day for an average positive or an average negative, basically. So let's move on now. We're going to look at the count, which is basically the number of occurrences that occur on positive days and negative days. So we're going to count all the days that are positive and negative, and 0. So to do that, we're going to use a slightly different formula, but roughly the same. So in cell J2, I'm going to type count, and K2 will be roughly the same formula as before, subtotal, open brackets, this time 2, not 1, because 2 is the function number for count, comma, and then the same references as before, so all are open to open data. And you'll see that the count is 1,995 days. That's fine, that's in line with our descriptive statistics as we would expect because the data is unfiltered at the moment. So moving on to sort of column P here, so P1 we're going to put pos count and neg count, so positive count and negative count, and then Q1 and 2 will actually paste the values into those cells. So let's change the open to open returns, filter them for greater than 0, so we'll do the positive count first. And you'll see that our filter dependent count cell here has now changed to 988 days. So we can copy that and paste it as a value as we did before into the positive count cell. And we'll do the same for negative count as well. And that's 986 days. Paste as a value. Let's clear the filter on the open to open returns. And the other thing that we should just calculate for thoroughness is the 0 count. So the 0 count is just going to be the total count minus the positive count minus the negative count, which is 21. So that's all the days left over. So all the days of 0 returns. To make this a little bit more understandable, we're going to put it in percentages as a percent of the total count. So we want to know the percentage of days that are positive and the percentage of days that are negative in our data set and the percentage days that are 0. So to do that, in cell R1, we're going to just type equals the positive count divided by the total count. And if we fix the total count cell reference, so if I press F4 around the R25 cell reference, it will add the dollar sign which fixes the dollar signs which fix the row and the column, so that that reference doesn't move when we copy this formula down, but this cell reference will move down, and that will calculate all our percentage returns slightly more easily. Let's format that as a percentage. So we can see there that 49.52% of days in our historical data set are positive. So the Aussie dollar is getting stronger versus the US dollar, so the price is going up. And the opposite for negatives, that's 49.42%. So slightly less, but very, very much similar, very symmetrical kind of data in that sense. And then the 0 count is roughly 1.05%. From that, what we can do is calculate some probability adjusted average positive and negative returns. What that basically means is we could adjust our positive and negative returns that we calculated here based on the frequency in which positive and negative returns actually occur within the whole data set. And the numbers that we're left over with are basically numbers that tell us, for example, with the probability adjusted average positive return, it will tell us the average daily return that we would obtain in the period, in the whole sort of historical period that we've analysed, if we only invested on days when the asset was up or positive and we weren't participating on the other days. So let's do that now. Shorthand, I'm just going to write ADJ for adjusted average positive return, and then similar for the negative one. And the calculation is simply going to be for the average probability adjusted average positive return, It's going to be the average positive return that we calculated earlier times by the positive count as a percentage, and the same for the negative probability adjusted average negative return as well. You can see I could drag that down there because these cells, it just uses the references below, which are the negative numbers anyway. So let's format those cells to percentages with much less decimal places. So 2, for example. Close that column up a little bit. So one thing to briefly note here is that, again, these numbers are very small, and it basically highlights that your day trading opportunities here are very kind of small, even if you get it exactly right. You know, there's not that much volatility in this asset that we're looking at, in the Aussie dollar US dollar, and so day trading opportunities are minimal. So now let's move on to looking at standard deviations and some more volatility analysis. So essentially what we're going to do is, a little bit like we did earlier with the frequency table, define some intervals that create ranges that we're then going to see how many daily returns lie within those ranges that are defined, and they'll be defined by 1, 2 and 3 standard deviations from the mean. So we're going to create a table for that to define the intervals, and then we'll do a count as well. So this is all about understanding how much data is accounted for by these 1, 2 and 3 standard deviations from the mean. And remember that standard deviation is our level of dispersion or volatility. So the more standard deviations either side of the mean that we look at, the more data that we're going to account for. So we're going to create a table now called standard deviation, STDDV for short, and then that's in cell W1, and in cell X1, Y1 and Z1 we're going to have 1, 2 and 3 for 1, 2 and 3 standard deviations from the mean, and we're going to create upper and lower bounds for those figures, 1, 2 and 3 standard deviations from the mean. So to calculate the upper bound for one standard deviation from the mean, all it is the mean plus 1 times the standard deviation figure. So in cell X2, all we're going to do is put equal to the mean, which we calculate in the descriptive statistics, plus 1 times the standard deviation figure, which is also in the descriptive statistics that we calculated earlier. And then for 2 standard deviations above the mean, it's the mean, very similar, plus 2 times the standard deviation figure. And for 3 standard deviations, it's the mean plus 3 times the standard deviation figure. And very similarly for the lower bounds, it's just simply the mean minus 1 times the standard deviation figure for the 1 standard deviation lower bound. The mean minus 2 times the standard deviation figure for 2 standard deviation lower bound, and the mean minus 3 times the standard deviation figure for the lower bound of 3 standard deviations from the mean. And these basically define our intervals that help us calculate how many returns lie within these ranges. So we're going to look between these two values for 1 standard deviation from the mean, see how many daily returns lie within those 2 bounds. The same for 2 standard deviations and 3 standard deviations from the mean. And then what we're going to do is take note and record those values in another table, another standard deviation table. So in cell AB1, I'm going to head this table standard dev 2, and then put 1, 2 and 3 standard deviations in the column going down, and what we want to do is calculate the actual number of occurrences that lie within those bounds. We want to convert that to a frequency percentage, so the actual number of occurrences within those bounds as a percentage of the total number of occurrences, or the count. And then we want to be able to compare it to a normal distribution. So we want a normal count and a normal frequency percentage. So let's go ahead and calculate the actual count numbers that lie within these ranges, 1, 2, and 3 standard deviations from the mean. And all we're going to do that is filter these open to open daily returns for between those numbers. So we're looking at greater than or equal to the 1 standard deviation below the mean, which is minus 0.00873, and is less than or equal to the upper 1 standard deviation from the mean value, which is 0.008792. Once we filter all our open to open daily returns for that, our count box that we made earlier, our count formula, will adjust and tell us how many occurrences are within that range. We can just copy that figure and dump it in the new table, paste it as a value within the appropriate cell. So the actual count within 1 standard deviation from the mean. Let's go ahead and do 2 and 3 standard deviations from the mean now. So this time we go between minus 0.0175 to 0.017554, and now we have 1,890 days that lie within that range, so we can copy that cell again and paste it into the 2 standard deviations either side of the mean actual count figure there in that table. And finally the same with 3 standard deviations from the mean. So we're looking at minus 0.02626 to 0.026316, and the count that we have, the number of occurrences of days with the returns that lie between those values, is 1962 in that case. So paste that as a value, and that's all our actual counts that lie within those standard deviation bounds. We can quite easily convert that to a percentage frequency figure, as we did before, by comparing it to the total number of occurrences in our data set. So for 1 standard deviation either side of the mean, it will be this actual count figure here divided by the total count, and again we can put an absolute reference around that cell reference, so that we can copy it down easily. So there we go, and let's format those cells to display themselves as a percentage to 2 decimal places. Now let's look at what a normal distribution would predict in terms of the frequency, percentage, and the actual count. So what we know from a normal distribution is that a perfect normal distribution accounts for, with 1 standard deviation from the mean, accounts for 68.2% of the data in the data set, and 2 standard deviations from the mean is 95.4% of the data points in the data set, and 3 standard deviations from the mean is 99.8% of the data points. And then we can kind of back out, reverse engineer the count figure from that just by taking the percentage figure for 1 standard deviation from the mean and times it by the total count in our data set. And again, we want to absolute reference the total count, so we can copy this down. And now we have some data in this table that we can sort of compare. So our empirical distribution, our empirical work here, versus what's predicted by a normal distribution. So let's sort of make some comments about that now, and sort of refer back to our histogram that we've got here. So what we can see is, with 1 standard deviation from the mean, we're basically looking at an upper bound of 0.9%-ish and a lower bound of minus 0.9%. So we're kind of looking at, from this column, minus 0.9 here, or here, to plus 0.9, which is here. So kind of this whole area here. And in our empirical distribution, that accounts for 80% roughly of the data, whereas a normal distribution would only predict 68%. So that then takes us back to our kurtosis value, which is higher than 0, which represents the peakiness in our distribution. So a kurtosis value of higher than 0 means that it's peakier around the mean than a normal distribution, which means more data lies within that range. So that's why in our empirical distribution you can see that 80% lies within a smaller area there in terms of ranges close to 0 than predicted by a normal distribution. As you go down to 2 and 3 standard deviations from the mean, that changes a little bit. So 2 standard deviations from the mean is roughly 1.7 plus 1.7% to minus 1.7%. So roughly from here to here. And in that case, we actually account for less this time than the normal distribution. So we've missed some data out here compared to a normal distribution, which means we must have more as a percentage in the tails after that. And then equally, that's the same thing that happens in the 3 standard deviations from the mean figure as well. In fact, it's slightly more prominent as well. We miss a bit more data. So what that is essentially saying is that our empirical distribution is peakier. It has much more data in a smaller ranges around the mean, misses out some in the middle on the way to the tails, but then has fatter tails towards the end. So there's more extremes either side, positive and negative, than the normal distribution would predict, and also many more in around the mean as well. So the key bits to learn from this analysis that we've done so far is firstly that if you're trading this asset on a daily basis, the opportunities are generally very low. The empirical analysis that we've done here tells us that roughly 80% of the time the percentage returns day to day are between plus 0.87% and minus 0.87%. And if we take a look at our frequency table that we did earlier, we can look at some narrower ranges than that, look at minus 0.6 to plus 0.6% returns, and we can see that if we add these probabilities here, it accounts for roughly 66% of the data. And even if we go even narrower still, we can look at minus 0.3% to plus 0.3%, and it accounts for 44% of the daily returns that we've analyzed as well. So these are all very small margins to play with, and remember that we haven't even accounted for transaction or financing costs here either. The second key takeaway from what we've done is to recognize the difference between our empirical distribution and a standard normal distribution. So when you hear about volatility calculations for any asset, we typically talk about the standard deviation of an asset. And so if there was a standard deviation figure of say 0.8% roughly, like we have here, close to here, what's being said is that if the data was normally distributed, then there would be roughly a 68.2% probability of the periodic returns being 0.8% either side of the mean. However, our empirical analysis shows that the chances are actually much higher for a suppressed level of returns, as is shown by the peaky distribution around the mean here in our histogram. And equally, there's also more tail risk in the extreme movements. So put simply, when compared to a normal distribution, more often than not, the returns are suppressed by more than the standard deviation would suggest, and the tail risk events are higher than standard deviations would suggest as well. It's worth mentioning here why we're even comparing our empirical distributions to the normal distribution in the first place. So firstly, the basic shape of a normal distribution is very similar to our asset returns empirical distribution that we've got here. So it's a bell-shaped curve, and it's roughly the same shape. Secondly, the normal distribution is very easily defined, so this is quite an important one. The only information you need to define a normal probability distribution is the mean and the standard deviation, and you can then sort of determine the whole probability curve. So that's particularly useful because it makes risk or volatility assessment with the standard deviation figure much more comparable across assets. So if you simplify asset returns to a normal distribution, you don't need to consider differences in kurtosis or skew between assets, and you can concentrate purely on on the volatility and dispersion as dictated by standard deviation. So for those reasons, it's basically become very commonplace for both normal distributions to be assumed and standard deviations as volatility assessments to be used in the financial industry. Although standard deviations are the go-to risk measure and assuming asset returns are normally distributed is very useful, the analysis that we're doing here is to make you aware of subtle differences and increase your understanding of opportunity and risk when dealing with currency trading. Now we're going to move on to analysing the high to low returns. The first thing to note here is that structurally high to low returns can't be any less than 0%. So since we've assumed that we're investing at the low and then closing at the high, it's not possible. So because of that, the normal distribution analysis and the standard deviation analysis that we did in the open to open returns becomes a bit void because of the structure of the probability distribution. Equally, there's also no point in looking at average negative returns and statistics like that. So what we're going to concentrate more on is looking at the frequency table analysis, and we're going to take a look at the histogram to understand the differences in the probability distributions, and also take a quick look at the descriptive statistics. And once that's all explained, we can move on to analysing the difference between the Aussie dollar US dollar pair and the Euro US dollar pair with a series of statistics that we've already calculated here. So the first thing to do before we continue is just get rid of this filter from the open to open returns column. And then we need to plot our frequency table. So in cell J36, I'm going to head this column intervals again, and then we're going to look at intervals above 0 because, like I said, with high to low returns you can't have yield returns of less than 0%. So we're going to start from 0.002, which is 0.2%, and go up in 0.2% intervals up to 4% max. And from those intervals, as before, we're going to create our frequency table data. So if we go to data on the ribbon and then data analysis, and then choose histogram here and press OK, we need to make sure that our input range goes from the high to low, uses the high to low data, so that's going to be H12, starting at H12 this time, all the way down to the bottom with Control Shift down on the keyboard, down to H2007, and then we're going to look at the bin range, which is the intervals. So that's from J37 to J56. And then the output range, we're going to make K36. And then if we press OK, it will plot our frequency table there. So from that, we can plot our histogram again. So we do that with that data selected. So just with the data, not the headings. We go to Insert on the ribbon and then Column Chart. And you can see here already that our histogram, our probability distribution for high to low returns is completely different in the way that it looks. It is not normally distributed at all. That's because of the structural fact that you can't have less than 0% returns, but obviously you can still have high volatility and a large tail in the positive side. So a huge difference between the high and low intraday is possible. So that's what creates this sort of lopsided distribution. So before we go any further, let's just label the chart and the axes. So this is high to low returns. So you do that just by clicking on the chart, going to Chart Tools, Layout, Chart Title, and then the same way, but this time axis titles, we'll label the horizontal axis first. That's going to be returns ranges, as in the chart above, and then the same for the vertical axis title, we'll name that frequency. So in this high to low example, I'm not actually going to go through and create all the text labels like I did before, just in the interest of saving time. What I'm going to do instead is just select the bin range that we've got there and format the cells to show themselves as a percentage to 2 decimal places, and at least that makes it slightly clearer on the histogram what's going on. And you can always refer back to the text labels here with how it works when it refers to the bin ranges, each of the text labels. So now let's move on to calculating the descriptive statistics. So we go to Data, Data Analysis, Descriptive Statistics, and we want to use the high to low data again in the input range. So that's from cell H12 down to cell H2007. We want the output range to be this cell Q36, and then make sure the summary statistics box is checked and just press OK there. So that's our descriptive statistics. And as before, we can change the format of all of these to percentages where necessary. So the mean to the sample variance and the range minimum maximum can all be percentages, and the others can be numbers to 2 decimal places. These are percentages to 3 decimal places to keep it consistent with above. Okay, so that's our descriptive statistics done, and from that, as before, we can calculate our probabilities and cumulative probabilities using the frequency table and knowing the total count from our descriptive statistics. So we'll head the next column there, probabilities, as above, and cumulative probabilities. And we work this out in exactly the same way. So we're looking at the frequency for this range of less than 0.2%, high to low returns, divided by the total count, so 80 divided by 1996. We're going to fix that cell reference R50 with dollar signs so we can copy it down easily, and then format all of those cells by right-clicking within the selection, formatting cells as a percentage to 2 decimal places. Then we go to cumulative probabilities, work this out in the same way as we did before. So the opening cumulative probability is just going to be the same as the opening range probability, so the opening range being less than 0.2%. And then from there we're going to cumulatively add up all the probabilities until you get to 100% of the data accounted for. And we do that by looking at the relevant probability for the range in that row and adding it to the previous cumulative probability and then copying that down. And then we can see by the end it accounts for 100% of the data as before. So the main things to note here is firstly the difference in the structure of the probability distribution, as we briefly touched on before, and it's not very close to a normal distribution at all. You can see that by the kurtosis and skew as well being extremely far from zero in both cases. And because of that distribution not being similar to a normal distribution, we're less concerned with the standard deviation as our default risk or volatility measure for high to low returns, and instead we can concentrate on some other ways of identifying volatility with these returns. So first and foremost, the obvious one is the average high to low return. So that kind of gives you the average maximum potential of your sort of day trading this asset. So on average, the maximum return you'll get intraday trading this asset is around 1%. And obviously when we compare that to other assets, you'll see differences in the volatility. The other thing we can look at is the maximum value. So the maximum high to low, the maximum intraday move that is measured in the period that we've analysed back to 2008 is around 11%. And also it's important just to bear in mind the frequency table data in general. So, we can get a good idea here of, say, the movements of more than 4% between high and low is around 1.65% of occurrences. So around 1.65% of the time, movements from high to low to high are over 4%, that basically means. And you can go through that frequency table with that logic as well, the same with the cumulative probability. So that's all sensible to do, as well as looking at the mean and the maximum high to low returns. Before I move on to a final cross-asset assessment and some closing remarks, I'm just going to make sure that this document is saved appropriately. So I'm going to go to File, Save As, save it to the desktop with a file name of AUD USD distribution, for example. Click Save there. So that's saved now. So the whole point of the distribution of returns exercise that we've just carried out is for three major purposes. Firstly, we want to understand, get a really good, deep understanding of how an asset, or a currency in this case, behaves and the risks and opportunities that it presents. Secondly, we want to highlight the lack of day trading opportunities in currencies most of the time. So we can see that by looking at various measures, but the main ones being the average positive and average negative returns being so low. Thirdly, we want to be able to compare the risk and opportunity across currency pairs. So I'm going to show you some of that now by comparing the Aussie dollar US dollar pair to the Euro US dollar pair. So I've got a pre-made spreadsheet with the Euro US dollar data in, and its format is exactly the same as what we just went through building in the Aussie dollar US dollar pair. So for example, our average positive and average negative returns here are plus and minus 0.44%. If we go back to the Aussie dollar US dollar pair, we've got roughly plus and minus 0.58%. So the volatility there is higher, or the returns are higher. On average, both positive and negative. Equally, we could look at some other volatility measures like the standard deviation of open to open returns, which is probably the main one that we should be looking at as a volatility assessment. So with the Aussie dollar USD, that's 0.867%. When we compare that to the Euro USD, that's 0.629%. So again, the Euro seems to have lower volatility in a pair with the US dollar compared to the Aussie dollar with the US dollar in a US dollar pair. So what I've done is kind of summarized a bunch of this information that we've gone through in this video for both the Euro US dollar and the Aussie dollar US dollar. So here's some key statistics that I've picked out. Probably the most important one is the open to open return standard deviation, which is kind of the major volatility assessment that we use. Equally, we've got the average positive and negative returns, which basically show you the opportunities that lie within these currencies when you day trade them, or when you trade them over the period that you're analyzing. And I've thrown in there the range, the minimum, the maximum as well, because that also gives you an indication of how the asset that you're looking at behaves, and it's another kind of risk-reward measure there. And on the high to low returns, as we discussed just a few moments ago, the key ones I've picked out are the average high to low return and the maximum high low return in the period. So what we can see basically, the final outcome of this cross-asset comparison with the Aussie dollar US dollar versus the Euro US dollar is basically that all our risk measures here are higher in the Aussie dollar US dollar pair than the Euro US dollar pair, which basically means that there's greater risk, but also hand in hand with that greater opportunity to profit from trading the Aussie dollar US dollar pair compared to the Euro US dollar pair.
Okay, so welcome back to the computer screen. What we're going to do here is have a look at what Chris has just gone through in the context of where we've been going with the overall volatility analysis throughout the video series so far, and really put this into context so we can cement the understanding of where this is all going. So if you recall, in previous videos, we got to our definition of different currencies through both their diversity or concentration with regard to commodities prices, and also from the regime that they're exposed to. And we've now got to a point where we have this tradable set, and the tradable set is defined by 4 different definitions of currencies. And we've got our X commodity floating majors, our X commodity floating minors, our commodity floating majors, and our commodity floating minors. So the first thing to notice is obviously that every currency pair in our tradable set is a floating regime. But secondly, some are more concentrated more than others in terms of their exposure to commodities prices. And we got to this point where we drilled down almost and said, okay, if we drill down through regime, we only want to be exposed in terms of volatility to floating regimes, but also we want to understand the opportunities and risk by understanding the difference between currency